Good morning, good afternoon, and good evening, everyone, and welcome to our Fall 2025 M&A Bootcamp. My name is Colin Mahan, and I'm a Director of Programs at the Nasdaq Entrepreneurial Center. And for those of you who may not know, the Nasdaq Center is a nonprofit improving access and knowledge in entrepreneurship to advance economic progress for all. As you're going to see in the chat in just a moment, the NASDAQ Center provides programs, resources, and exceptional mentorship to help entrepreneurs fuel prosperity, no matter where their journey begins. Be sure to check out the links and resources shared in the chat. Now, I'm going to launch a few polls to take a step back and take a temperature gauge on how all of you are doing today. We use this information to guide the programs we provide for this global community of entrepreneurs. The first poll: how are you feeling about your business? Are you optimistic? Are you in survival mode? Let us know, and thank you for voting. Again, we use this to help understand where we should be adding more support out there for you entrepreneurs. If there are any topics or specific challenges you'd like us to create resources for, feel free to share those in the chat as well. A couple more housekeeping items. I see some of you already doing this in the chat, but let us know where you're dialing in from by dropping it into the chat. We'd love to see where everyone's joining us today for our time together. Secondly, we're going to have live Q&A near the end of each panel, so please feel free to submit those questions at any time using the Q&A box at the bottom of your screen. We'll do our best to get to them all. All right, let's see where everyone's coming in from. Maryland, welcome. Philadelphia area, love it. Bryan's Road, Maryland. Okay, lots of East Coast. Florida, Chandler, Arizona. Great. Welcome, everyone. Durango, love that. Atlanta, Taiwan, welcome. All right, awesome. We're going to keep running these polls, and thank you all for letting us know where you're coming from. New York City in the house. Love it. Greenville, South Carolina. All right, awesome. Luxembourg, good evening. Pleasanton, Fort Worth. All right, our last poll. And while your answer, our last poll is what's keeping you up at night? Again, we use these topics to fuel the next couple of months of programming. But while you're answering that last poll, I'd like to take a moment to recognize the incredible support of our corporate partners. The work we do at the center wouldn't be possible without all the generosity and belief of our partners and funders, including Nasdaq, Wells Fargo, JP Morgan Chase, KPMG, Walmart, the Asia Innovation Hub, Wilson Sonsini, the Narit Foundation, and BPM. We're deeply grateful for their partnership and hope you'll join us in sharing that appreciation as well. So, without any further delay, thanks for participating in that last poll. We're going to end that and share those results. Looks like finance and sales are at the top of the key, which we will definitely be covering a decent amount with regards to M&A today. So please join me in giving a warm welcome to our first special guest presenter for our market update. Grant Hefferman is a managing director of software investment banking at KPMG. Welcome, Grant. Oh, your audio's.
Oh, can you hear me?
Oh, I got you now.
Okay,
Perfect.
perfect. Well, thanks, Colin. I appreciate it and excited to be here. So, ahead of this call, we prepared a handful of slides that we'd love to walk through and share a little bit about how we see the market today. So, without further ado, let me just pull up the presentation. Bear with me. All right, Colin, we good from your
Looks
side?
great. Looks great.
Perfect. So, before we get into a bunch of graphs and slides, we just wanted to provide a little bit of a snapshot on state of capital markets today. And I think it really boils down to kind of five key considerations. I think the first and foremost, nature's healing, right? We're seeing improving macro tailwinds that are really accelerating M&A and kind of IPO market activity right now. We're seeing credit environments improve. We're seeing interest rates continue to decline. We're seeing good guidance from the Fed. And what this ultimately gives us is a foundation from a leverage perspective and broader financing lens to do more transactions in IPOs. Another really important dynamic here that we're facing is that private equity capital continues to face deployment pressures. PE is sitting on $3 trillion of dry powder capital right now. Coupled with that, there have not been a flood of quality deals in the market. So that actually leads to a really interesting dynamic for founders and entrepreneurs like yourselves, that there's such a scarcity value of quality deals coupled with $3 trillion of dry powder capital, that at least what we're seeing on the M&A side is very, very competitive processes for best-in-class assets. Another really important dynamic that we're seeing is the illiquidity pressure at private equity firms continue to mount. The name of the game today is distributed to paid-in capital, meaning as an investor, how much capital have I received in return for the initial capital that I wrote to that private equity firm or whoever it may be. Those periods of DPI are really elongating for investors, and something that is very much top of mind for the broader kind of private capital market today. Next really important point is that strategic buyer mindsets are shifting. Technology buyers, which is where I spend my time as a software investment banker, is they're trying to reinvent themselves. There's a little bit of that innovator's dilemma dynamic that we're seeing, right? How do we reinvent ourselves, and how do we basically operate in this world of AI today? The last point then, and just as important, is that the recovery is not even across sectors, right? While we see a lot of recovery in technology, other parts of the market, which I'll get into, are a little bit more sluggish. So shifting gears to some kind of the numbers. If you look in the US markets, the great news is that from a dollar perspective of M&A, we're already exceeding 2024, and we're only 9 months into the year. As you see on the top graph, we've basically grown from 1.3 to 1.8 trillion dollars in M&A volume. Yeah, we're a little bit down on the volume side of things. If we switch gears to the IPO side, we're continuing to see a lot of acceleration there, albeit not to the level that we saw in 2020 and 2021, but we're seeing quality names going public in the market, whether it be Figma, CoreWeave, and a handful of these other really tier one companies. I think the key takeaway there is that if you are going public, the bar to go public is substantially higher than the market that we saw kind of in the pandemic world. If we look at things from a sector lens, this is kind of what I was mentioning earlier, is that the recovery isn't equal across all sectors. If you look at technology as an example, we're seeing that market as an example really kind of normalize to kind of pre-pandemic and higher than that levels, right? Whereas other sectors, maybe that be consumer, still remains kind of under those pre-pandemic levels. Part of that, what we attribute to the dynamic, is the fact that a lot of those industries like consumer and others that are tied to leverage ratios, they've been slow to recover because of basically that interest rates are kind of stuck at that high level. But now that they're starting to normalize and decrease, we're seeing a lot of acceleration outside of those non-technology sectors. But I think the key takeaway as a entrepreneur and as a company is that EBITDA is really the anchor metric, whether it be we're talking technology or whether we're talking kind of broader kind of M&A dynamics, right? Growth at all costs is no longer a strategy. It is all about durable growth and path to profitability dynamics. I mentioned this earlier, right? When we look at the M&A and fundraising environment, if you look in that middle graph, right, we're basically sitting at $2.97 trillion of dry powder capital that is yet to be deployed. Once again, it is a massive, massive issue with the quality of assets right now. And as I mentioned earlier, within our processes in particular, if you're bringing a quality deal to market, we are seeing the private equity firms just absolutely chasing as hard as they can. As an example, like a typical process is from an indications of interest perspective. Let's just say if you receive 10 or 15 indications of interest, that's a very good process. Right now, with some of the processes that my colleagues as well as myself are seeing, we're seeing 20, 30, 40, even 50 offers on companies. Because of that inability to deploy capital, these firms are doing everything they can to deploy that capital today. On the flip side, if you look at the global fundraising dynamics, that continues to decline. Because if I'm an investor, whether it be a pension fund or a family office, right? If you haven't returned capital to me from your previous fund, it's a little bit tough to put just additional capital into their subsequent fund, right? So you're seeing that dynamic slow quite a bit, as you can tell on the top graph. And then finally, if you look at the very bottom, interest rates are moving in the right direction, right? Which is going to allow markets to open up a little bit, capital to be deployed, and so forth. Shifting gears a little bit, Iconic Capital, which is a really tier one growth equity firm out in the Bay Area, I guess global at this point, released a really important report called Iconic State of Software in 2025. And just having focused on software, there was a few slides that I wanted to bring to this conversation that I thought were really compelling. I think the first one that's really interesting is this chart of what they track is percentage of public earning calls mentioning AI. And as you can tell here, it is top of mind with every strategic buyer. And this is a really important dynamic that we're seeing, at least on the technology side, is that within the strategic market, particularly when we're talking to the corporate development departments and other people that are the decision makers on M&A, unless there's an AI strategy attached, they're probably not going to look at that asset. And that's a really interesting dynamic, right? Because we're seeing this interesting dynamic where strategic buyers will pass on a really tier one software or application software company if it is not an AI native or AI first type of company. So within the technology world, I think companies are seeing that writing on the wall and figuring out how do we adapt, how do we improve our strategy to fit that mold. So that's just something that I want to bring to this conversation because it's a really interesting dynamic how the public markets are so worried about blowback associated with buying a non-AI company that it's kind of AI or nothing at this time. Another really important thing that I want to highlight is from this report is what we look at as the rule of 40 mix. Within the software world, there's this metric called rule of 40. And what this means is your mix of your free cash flow margin plus your revenue growth. And what we're seeing right now is a shift to durable growth. In the 2020, 2021 era, when you looked at that rule of 40 mix, it was 70% revenue, ARR growth, meaning recurring revenue, and 30% free cash flow margin. Whereas if you look in 2025, it's almost 50-50. That's a very, very interesting dynamic at play because it just shows that we're moving from a world of growth at all costs to a world of what is the durable growth. I need to have conviction in terms of our path to profitability and truly strong and durable unit economics, right? Because in 2020, 2021, when you had interest rates at basically zero, you kind of make the math work, right? From a unit economics lens. Whereas today, if we have more, higher interest rates, it's a little bit like we need to prove that out, and buyers in that environment are a little bit more skeptical of the massively burning companies and things like that. The final thing I'll leave everyone with is within the technology space, we are seeing massive acceleration of the billion-dollar plus deals. As you can tell here, the number of multi-billion-dollar deals that have happened in 2025 are pretty staggering, right? And you can see that based on the quarterly trend that we have right here, right? It continues to come up, whether it be Google acquiring Wiz, Salesforce buying Informatica, and a handful of these other ones that we've highlighted below. The fact is that the multi-billion-dollar deals that are truly strategic and shifting and helping these strategic buyers reinvent themselves, I will say the strategic buyers are willing to kind of sharpen their pencils and pay premium value for those types of companies. So I've thrown a bunch at everyone, but I think the key takeaway is, right, the market, the macro picture is improving. We have massive amounts of dry powder capital that need to get deployed. And we're seeing recovery within those sectors that have been more tied to leverage on a historical basis. So I think overall, if you're asking what's your key takeaway, Grant, is that 2025 Q4 is already seeing a lot of acceleration, really post Labor Day, but we think that's really going to continue to recover into the 2026 timeframe and beyond. So
Awesome, Grant. Great information, great data there. And yeah, I loved what you started off with nature is healing itself. So hopefully those awesome trends for entrepreneurs will continue. So appreciate you sharing your insights on our market update. And thanks for joining us today.
of course, happy to be here.
Alrighty, well, for our attendees, we've got our next panel up, which is for M&A strategy for early to mid-stage entrepreneurs. So please welcome our moderator, Dahana Pawar, who's our advisory board member at the Nasdaq Entrepreneurial Center and also the CEO of Varia Tempo. We have Diletta Onofrio, sorry, Diletta, a partner at KPMG, and Mark Holloway, partner at Wilson Sonsini. Welcome, panel.
Thank you so much, Colin. Hello, everyone. Like Colin said, I'm Dana Pawar, and I'm so very excited to be here with all of you today. Thank you again for joining us. I know from all over, which is amazing to see. This is going to be an incredible panel. A little about me. I've been on Nasdaq Center's advisory board since its inception in 2014, believe it or not. And today I work very closely with companies on fundraising, scale, and M&A. This panel is super special to me because I clearly remember the day when my first company got acquired and how exciting and nerve-wracking it was. I've been incredibly lucky to have been part of multiple acquisitions and or an IPO. So I know what you all are going through or preparing for. Now it gives me even greater pleasure to have you meet our brilliant panelists, Diletta, who's a partner at KPMG, and Mark, who's a partner at Wilson Sonsini. I would love to get started, both Mark and Diletta, by giving you a chance to introduce yourselves, starting with Mark, followed by Diletta.
Thanks, Donna. So Mark Holloway, partner at Wilson Sonsini. I'm here in the Washington, D.C. office. I focus on mergers and acquisitions. I do both domestic transactions. So about half my practice is doing M&A in the U.S., a mix of buy and sell side work focused on technology companies with a little bit of life science thrown in there for some spice. The other half of my practice is doing cross-border work for deals involving the U.S. and some combination of the U.K., Europe, and the Middle East.
That's great.
And hi, my name is Diletta Donofrio. I'm a partner in the West Coast for KPMG, and I'm working primarily on technology companies. One of the things that my practice is doing systematically is trying to inject the technology, particularly AI and Gen AI, into everything that we do across the life cycle, from diligence to post-integration and value creation. And that's obviously something that the technology companies are very eager to adopt more and more.
That's great. Welcome, both of you. And as we all heard Grant talk about how there is a lot of optimism. The last time we did this panel, by the way, or I moderated this panel, was last year, and it was all doom and gloom for the most part. And I'm so hopeful and excited with all of the optimism, which is fantastic to see. We heard a lot about AI, which we'll talk about in a little bit as well as actual real value creation. So these are really interesting times across the board. This question is for both of you. How would you describe the current M&A environment for early to mid-stage companies? And has the deal flow and investor sentiment shifted compared to the last few years?
Deletta, since I introduced myself first, you want to start with this one?
Yeah, sure, very kind. Overall, I would say cautiously optimistic, and I know this is a word or a terminology that has been overused in the past couple of years, but definitely that's what I see in the market. As we just said, by presenting the number, in general, the deal activity is on the rise, and there are several factors that are driving that, and dry powder is one of them, as well as access to capital. But definitely, what it seems to be a theme that is quite recurring is this value-conscious approach, where value, profitability, and not just revenue or top-line growth are important. And in order to truly assess the value, then companies seems to be focusing more and more on very careful diligence, helped by technology, given the fact that there is access to so much more data and information that can be elaborated quite rapidly and then question and refine over time. So that's definitely a topic that I see for the early to mid-stage companies.
That's great. Mark?
Yeah, great. Seeing similar things. I think everyone really hoped that 2025 was going to be a breakout year for M&A. 2023, 2024 were modest. It's probably a kind way to put it. Those expectations for a robust 2025 were delayed. Some uncertainty, tariffs were a big part of that, kept things quieter than we'd hoped in the first half of the year. The second half of the year, around July, a switch seemed to flip. And suddenly, some of the macroeconomic factors that had suppressed things before just faded into the background, I think, for a lot of people. And they decided, hey, we need to do deals for different reasons, and we can't wait any longer. And so deal activity picked up to the point that we've been joking amongst ourselves here at the firm that it's starting to feel a little bit like 2021, which is one of the busiest years in M&A that we've had in some time. So that's generally a good thing, although there's some moments of panic. I think Grant touched on a lot of the key factors that are driving that, right? More activity in the capital markets, lower interest rates, super helpful. And since we're technology focused in the kind of work that we do, I see AI exerting this huge gravitational force on the rest of the market, where even things that are pretty ancillary to M&A are getting impacted by all the huge deals that are happening in capital raising, commercial deals, M&A in the AI space.
Could not agree more. And I think, Grant kicked us off with that as well. It's kind of interesting because we talk a lot about value is key right now. It's, you really want to derive value from M&A today versus all the hype of the previous years. But then you also have the AI hype, which again, like I said, we'll address in a little bit. But I also do think that strategic M&A is also like a key trend that's emerging. So we'll get more into that. But Diletta, I want to talk a little bit about just what the buyers are prioritizing. So from a financial and strategic advisory perspective, what are buyers prioritizing right now? Are they more focused on revenue, profitability, or strategic synergies, or all three?
Yeah, very much in line with the answer to the prior question. It's probably a blend of the three. But with a particular focus on synergies. And when you look at synergies, therefore you relate to profitability, because profitability is revenue, but also cost savings. So in general, acquirers want to see a clear and plan for how the acquisition will add the value to their company. And again, value is profitability. Value is profitable growth and market expansion, and obviously the integration with new technologies.
That's great. So just in terms of, just as an extension of what you just said, Diletta, Mark, it's financial legal, right? 1-2 punch for M&A. From the legal side, are you seeing deal structures evolve, in terms of earnouts, stock versus cash, contingent payments? And if so, how are founders adjusting to these changes or not?
Yeah. One of the big drivers for the last couple of years with higher interest rates has been, cash is the cost of capital is higher, cash is precious, and so buyers have been using stock more often for all of the consideration or a portion of the consideration. I'm expecting as interest rates go down that cash is going to be, more of the consideration, maybe all of the consideration. Um, I wouldn't say that on the sort of the earnout contingent payment front, I don't know that that's been a trend. I mean, they're definitely used. Earnouts are a classic way to bridge gaps on, future performance where sellers think they're going to have amazing growth rates in the future. Buyers are not quite as convinced. Earnouts are a way to avoid having to agree on what those growth rates are going to be and just pay buyers or pay sellers rather more money if they overperform in the post-closing period. The biggest thing we've seen in the structuring piece is around larger AI deals. For at least 10 years, the idea of an acqui-hire or some non-traditional M&A where maybe you really care about the team of people at a company, maybe you care about a particular product or asset, but you're not looking at the business as a whole, and you're sort of selectively taking a few parts of the business and maybe leaving the rest behind. That's been a function for, smaller and mid-stage companies. What's been really interesting to see is some of those things come into the, billion-dollar, multi-billion-dollar space for AI companies, where it's the really valuing the sort of those rare math PhDs that can create models or data sets, or finding ways to exclusively license the technology rather than acquire the company. So that's been pretty interesting. Those things, we saw those at the smaller stages previously, had not seen them with any real frequency at the kind of billion-dollar plus stage. So that's been an interesting development.
Could not agree more. And before I get to the next question, I just wanted to welcome the new participants, and also to everyone. We will have a Q&A at the end. So please, please, please do submit your questions in the Q&A function. Thank you for everybody who's already sent their questions ahead of time, but please keep submitting your questions and we'll get to them at the end. So this is a question I get a lot from founders that I work with. And that is when and how founders should start preparing. And as you know, with M&A, preparation is everything. So this question is to both of you, Diletta and Mark. What signals should a founder look for to know their company is ready or not ready for an acquisition conversation?
Yeah, so they're both internal and external. Let's start with the external one because they're probably easier to define. Every sector, every segment have different M&A dynamics, as we discussed, right, in terms of volume and characteristic of the deal. So definitely you need to master and know very well what is happening in your, not just sector, industry, but actually the segment where you are operating with your product and your technology or your services. The other thing is the players in the sector and the ecosystem, right? Who is buying, who is selling, who has capital, who are the PE firms that are involved in some of the most important deals. And then regulatory is critical because regulatory is going to become more and more important as we look at more global deals. And there have always been global deals, obviously, but given some of the political dynamics, regulatory will probably play a bigger role in shaping M&A. These are kind of the three external ones that I would consider. And then look at internally, so within the company, the company has to feel ready to go through this step. It's a little bit like going public, right? Where you go through a readiness process to make sure that actually by the time you go public, you're not going to kind of suffer in terms of infrastructure processes and compliance. So the first thing is the revenue side, right? The revenue cannot be a random number that the company doesn't control, but has to be a controllable number, predictable, as well as the margin. We talked about the importance of profitability. So to be able to control these two simple metrics, which obviously can be articulated in churn and return on investment and other sub-metrics is really, really important. The second aspect internally that should be considered is the financial. The financial have to be clean. Controls need to be in place so that actually these financial are auditable and understandable in a very simple way. And then if you look at the back office and operation, is going to have to have some sort of scalable operation that can be either integrated in the acquire or improved over time, but they have to be solid in terms of processes and scalability. And then finally, and that's something that is really, really important to build early on, is the value proposition, is the narrative around what the company does, what doesn't do, what the company is good at, what is not good at, and what is good at, what are the terms of the growth and the extension or future possibilities. So in general, all of this has to be substantiated by some sort of metrics that need to be measured over time in a systematic way. And if you have all these components, then I think you are ready to have this conversation.
That's great.
I think that's a great answer. So I don't want to add too much to it. I think the one sort of dynamic I would think about is just on the internal side of things. One, I mean, obviously, do you need to sell, right? Is it a question of, is it challenging to raise capital or on attractive terms, if at all? Do you have investors where they're pretty happy with the company, but their fund is coming to the end of its life and they need to liquidate their investment? You've got founders that are just ready to move on, so that, if you can't sort of separate them from the business, then maybe you sort of need to sell. Selling takes several months at least, and so you want to give yourself some run room there to do that. The other thing on the sort of internal perspective is some moments are better to sell than others, in the sense that it might be a case. I was talking to somebody yesterday where they had a great product. They did, $10 million in sales a year. They came out with a new version of the product, and sort of everyone in the market agreed it was way better than the old one, way better than anything that else was out there. And suddenly they had a $40 million backlog. And they thought, we weren't necessarily thinking about selling, but I'm not sure our projected growth rate's ever going to look as good as it does right now. There's obviously execution risks on whether we can deliver on all of this, but this might be a really good time to exit. And so they might have those moments where sort of the stars are aligned in your favor, and maybe it's time to go for an exit, even if you weren't necessarily kind of ready to do that otherwise.
Both fantastic answers, and I couldn't agree more, Mark. I've been in the Valley long enough, and as I said, I've been part of multiple exits. I've seen one too many times the founder, CEO say no to an amazing offer and then later on sell it for pennies, just because they thought the company was worth way, way more. And of course, we've also seen the reverse. But I agree, timing is everything, and really understanding the strategic value. And I think we've been talking about value and strategic value a lot. I think those are two things that are really critical. And lastly, again, Mark, to what you said, it takes so long. People underestimate how long it takes. It's like almost like a full-time job at some point, which is why we'll talk about how important it is to have the right people behind you to work with you. Mark, I'm going to stay with you on this one. We talked about the preparation, but what are the most common legal or structural issues that slow down potential deals for startups?
Yeah. Because we work with companies from inception all the way through, it's a nice vantage point to sort of help folks understand, hey, these are issues that ideally you'd get right, but they're not likely to mess up your next financing. They're not likely to mess up a potential sale of the company, whereas others very much are. A lot of it kind of just boils down to uncertainty, where it's really hard for the buyer to figure out, well, is the company worth as much as I thought it was? Do I want to even do this deal at all? And those are the kind of things that can really stretch it out. Examples of that are sort of uncertainty around ownership, right? Did the founder make a sort of poor decision and write on a Post-it note that he was going to give 5% of the company to his brother several years ago, right? Where it's like, what is the legal significance of this? does the company own its intellectual property, right? Has it done a good job of documenting those things, or is there a lot of uncertainty around that where we may need to go chase people that don't work for the company to assign all the work that they did, clearly to the company? Are there areas of kind of legal non-compliance, like were you selling your product in a bunch of different states without really paying attention to state sales tax? It could take a little while to hire a great firm like KPMG to kind of figure out for you how much do you owe those states? And it could be, 6 or 7 figures in a bunch of different states, and just sort of figuring out how to figure out what to do with the purchase price when you've got that unknown but potentially significant set of liabilities out there. Sometimes that legal non-compliance means, oh, okay, I actually need to go to a regulator, right? I wasn't really paying attention to the countries where people were using my product, and it turns out that I've got users in a bunch of sanctioned countries. Need to shut off their access, and may need to talk to a government agency before the buyer will be willing to close.
Could not agree more. And it's so interesting to me because people always think an M&A is the easy route versus an IPO. And actually the amount of due diligence and paperwork and preparation and infrastructure, legal, all the different building blocks that need to go into place, it's staggering. And I think, again, people underestimate that as well. So Diletta, this one is for you, staying on the legal thread. When is it appropriate to bring in advisors like KPMG or a legal counsel from Wilson Sonsini, for example? And what should founders expect from that partnership?
Yeah, there is not one single answer to that, because it very much depends on the founder mentality and the company as well. But I think that company like ours, respectively, and please confirm if I'm incorrect, but we tend to invest quite a bit in maybe smaller companies that need advisory services, and in the long term they will grow. So I don't think there is any harm in not involving a firm like ours very, very early on, even prior to even identifying a potential deal or an exit, to kind of gain the advice around the checklist of the internal and external factor, and maybe deep dive a little more in some element that may be missing to be ready for a transaction. So it's never too early, in my perspective.
Great advice. Mark, anything you want to add there?
No, I agree. I think we might touch on this later, but there's nothing I value more than getting a chance to be involved either before a company starts thinking about it, about M&A, or get involved at the term sheet stage. And that can be done in a way that is sort of low to no cost, right? Because there's a huge value in arming people that are not repeat players in this business, or this sort of deal structure, to say, hey, look, this is what to expect. Here's how to get prepared. It's a lot easier to do that when you're not in the midst of M&A, right? When you're in the middle of a deal, there's so much going on. There's so many demands on the bandwidth of the company's time and team, that any kind of prep work that you can do is super helpful. A lot of the learning curve, I think, for founders is generally almost completely straight up into the air. And so any kind of learning you can do on the front end can be really helpful too, so that you're not trying to do that when you're trying to do a million other things, in the midst of an active deal.
Right. Preparation is everything. Let's switch gears a little bit. Let's talk about everyone's favorite topic, which we don't hear much anyways. Just kidding. It's about AI. We all know for the first time, we heard Grant talk about this as well. AI startups are on pace to capture more than half of all global venture capital funding. And like Grant said, if you're not doing AI, it's, you're not really attractive anymore, right, to investors or even M&A. So what are you seeing there, and how is the landscape changing? Just in terms of what should should the companies do early in terms of AI strategy and to prepare for, what's happening in this ecosystem right now?
Well,
Sure. Go ahead, Diletta.
Yeah, what I see is two sides, right, of this AI. One is a lot of tools and technology that is used actually in the deal. And maybe I'm a little biased because obviously I have a practice around that, but in the deal to AI power, if you like, integration, AI power diligence, and the rest of it, right? And but also what I see a lot is a lot of company with strong AI and data analytics capability that manage to command a premium over companies that instead don't have that type of capability. And obviously we are early stage, so to truly assess the functionality of the capability takes time. But to have one and iterate over time in order to augment the narrative that we talked about is highly advised.
Could not agree more. Mark?
Yeah. What I see to sort of add on to that is having an AI strategy is critical, even if it's not that relevant to your business, and just being able to defend, we've evaluated this, we've looked at it. It's not hugely helpful to us, or like, here's the real use case. On the flip side, being able to explain, why the use of AI in your business, or lack thereof, doesn't create existential risks, doesn't create other risks. It's a space that's so new that people's views of the risk created by the use of AI are all over the place. And so what we're seeing in the negotiations on deals is, for folks like us that have to deal with this stuff all the time, we've had a few more reps on it. If we're dealing with folks who haven't, buyers or their advisors that haven't spent as much time thinking about it, it's like, oh, well, I don't know, AI, there's a lot of risk. What if you're using data that, you don't have access to? We're like, the only use of AI here is the sales team, doing first drafts of cold emails, like, not a lot of risk. Versus if they're using AI agents, okay, well, now you have technology talking to your customers, right? Is it saying the things you want to say it to? Is it saying things that you would fire an employee if they said to your customers? Do you have a giant data set or a model that is using data like that you have all the rights to? And so doing a little bit of prep work with your outside advisors on, okay, how am I using AI? Is it in a way that I'm going to need to explain to buyer and explain sort of the safeguards I've taken, why it's low risk, can help kind of speed deals along, especially if you're dealing with a counterparty that hasn't spent as much time thinking about it.
Right. And to add to that, like Diletta rightly said, it's all about the tools, right? I see one too many times, everyone's like, I'm so and so with AI, so and so with AI, right? You don't have to just add AI to everything because it's cool. And if it doesn't make sense, you don't have to go down that path. But having said that, I think someone in the comments said that as well. You need AI to scale. And there are ways where you can use AI super smartly in every aspect of your business. And you can highlight that. You don't have to just use AI for the sake of using AI. I think to scale, AI is an amazing tool. So think of it as a tool. If that's not your core business, if AI is not your core business, think of it at least as a tool to help you scale. So that would really be my advice. So let's shift gears a little bit to provide practical guidance for our audience. So for founders that are navigating deals, Mark, what are the biggest misconceptions founders have about M&A, especially around control, valuation, privacy, and confidentiality?
Yeah. We've touched on two of the biggest things that I think people don't appreciate, how much work it is. And if you've never raised outside capital, some folks are able to bootstrap until exit. I think the M&A process feels that much harder because they've gone through a sort of mini version of it. If they've raised money, they've dealt with outside investors in the diligence process. The M&A diligence process is still a lot more work, but they've got at least some sense of what's coming. Whereas if they haven't, it's tough. It's going to be a huge distraction from your business. It's very difficult to focus on your business while you're doing M&A. And so, anything other than sort of basic maintenance gets pretty tough as it relates to your kind of regular business. The term sheet is so incredibly important. It's your point of maximum leverage. You're typically going to grant exclusivity for some period of time after that. And that's the point at which you want to try to get as much certainty around the price. Sure, you've got a headline number, but is it all cash? What sort of adjustments are there going to be to it? Are those adjustments going to be in any way surprising to you that reduces the overall purchase price? What sort of remedies does buyer have post-closing if the business is not as promised? There's a lot of ways in which you can take some of those big issues off the table. Much easier to negotiate those on a 5-page term sheet or LOI than it is in a 50 to 100 page, definitive agreement. And so on the sales side, love to kind of get as much of that stuff out of the way as possible at the term sheet stage.
Yeah. So this one is again for both of you, and Diletta, we can start with you. But many early stage founders are approached before they feel ready. So what's your advice on handling inbound interest, which is a good thing to have, but how do you handle that inbound interest without losing focus or leverage?
Yeah, is again, maybe not to introduce too many framework, right? But is in a sense, you need to triage information, but more than anything, you need to have a process. Because otherwise you may be distracted by your core business. And so the inquiry should be very well articulated in terms of fit, in terms of timing and valuation expectation. And also this process should include some do and don'ts. Don't over disclose and use NDAs for or similar vehicle to make sure that whatever information you provide is actually protected. And also maintain your option open, because you never know where the best buyer may come from and at what time may come from, right? So to kind of narrow your option just because you have a buyer, I don't think is always wise. And also by the converse, you may want, when you identify a good match or when you are identified by a good match, introduce stuff like a no shop clauses to kind of protect the initial conversation and make sure that there is trust and the deal evolves in kind of a natural way. And so overall, a process and some good rules, a good playbook should help.
I think that's really, really sound advice. Speaking of trust and having a good playbook, this question is for both of you, and I'm going to go back to AI. Do you think the shift towards AI, with the shift towards AI, data privacy, digital transformation, due diligence, valuation, all of this, how do you think this shift towards AI is playing in early stage deals?
Mark?
Yeah, no, it's an interesting question. I see, I feel like I'm sort of repeating myself, but there's such a sense of fear of missing out with respect to AI. There's the sense that, there's only so many models out there. There's so many data sets, so many sort of math PhDs that are capable of creating these things. And a sense that we'll see if it turns out to be true that there's only going to be a few winners in this space and that everybody else is going to be, acquired by or driven out of business by these folks. Not sure if that's true, but a lot of the market is acting like that. And so it's driving a lot of kind of fear-based decision making with pretty high risk tolerance because doing nothing is simply not an option. The other thing, so I mean, that obviously has an impact on valuations, has an impact on speed. One example of that is there was a company that we helped buy for a certain amount of money. 11 months later, the client sold it for 1/10 of the price because in that time, their AI strategy had pivoted pretty hard to say, oh, well, we wanted the option to do this, but now we're not going to do that. So that's fine. Just sell it off, get rid of it. But that's the kind of the pace at which things are moving. That's a lot faster than you normally see, people make decisions and make strategy changes and big investment decisions like that. The other thing, I mean, this is true for sort of all startup deals where you might think about, I'm going to sell my company, and buyers might say, I don't actually value your company. I might like your product, I might like your people, I might like some of the relationships. I don't necessarily value the whole thing. I don't necessarily want the whole thing. I think that's even more true in the AI space where, is it the data? Is it a model? Is it people? Might be attractive, and that could drive the whole deal where the buyer says, I just want that. The rest of it, I'm not interested.
Yeah. Diletta, do you want to?
Yeah, and I'm not going to be adding much more other than kind of putting some thought around the fact that the majority of the interest often seems to be around the talent, the engineers, and the one that can actually build agent, build LLM. And and as a result, maybe that could lead to undervaluing the company because acquiring people and talent is not the same value that you assign to acquiring a business, right? And that's why I'm going back to the conversation of, building an infrastructure around the talent. So it's not just talent, but it's a product, it's recurring revenue, right? So that's the challenge I see right now.
I love it. And one thing I'm just going to also add is, we keep talking about AI all the time, and that's all we all hear about. But at the end of the day, the core of any business or even M&A, and I've been through a lot myself, people sell to people, right? And at the end of the day, you don't forget the human value. And so while we talk about AI all the time, please remember one thing: people sell to people. So whenever you're dealing, with your M&A, think about that as your underlying philosophy or value, and then everything goes on top. Because we have so many international members in the audience, I am going to switch gears a little bit and talk about, how do we prepare for international deals. So Diletta, this one's for you. What are the top financial or tax considerations for founders who may be operating or incorporating across borders?
Yes, so this is what we do very often. We have so many professionals that are trying to even keeping up, right, with the constant evolution. Tax efficient strategies in M&A are critical because in order to execute a cross-border transaction, there are so many tax implications that you need to keep them in consideration prior, during, and after the deal. Then there are areas like repatriation of proceeding of the sale based on where the founder or the co-founders are based. Those also have an impact and consideration that need to be taken into account early on. Then sometimes we forget about currency, but anything to do with FX has a tax implication, and also when it doesn't have a tax implication may have an impact on the final result of the deal. And then finally, on the people side is global mobility, right? Because many of these deals have employees that maybe need to relocate or they are relocating. They were under a certain type of policy from a mobility perspective, and the repatriation will lead to other losses or artificial gain, and that need to be leveled as well in the course of the design of the transaction.
Great. I could not agree more. And again, so many differences between, doing something internal domestically versus having international deals. So Mark, I'm going to continue with the same thread. How do international or cross-border deals differ legally for smaller startups versus later stage companies?
Yeah, great question. So quickly, international deals or cross-border deals are challenging for a few reasons. Some will just kind of be apparent up front. Maybe there's different deal structures that you use. Maybe there's different terminology across border. There's sort of other layers that you get into, and some that might never be stated. You've got communication and cultural differences, which I think people are sort of generally aware of. But one of the challenges that can slow down deals there is that you may have very different legal systems in the sense of it's not just the laws themselves, but the assumptions in the market about how does risk get allocated between the parties, where it's very sort of diametrically opposed between one country and the next. And that can read as people being very aggressive when they're just doing deals the way they do them, right? And then the sort of moral sense of like, no, it's how they're done. It's like, well, that's how they're done there. Here, it's very different. And being able to sort of tease those out, realize that sort of gap in expectations and figure out how to bridge it is important. Otherwise, that sort of unspoken difference can, to your point about, your people selling to people, right? Those people can get pretty heated with one another if they don't realize why they're coming at it so differently. To get to your specific question on what's different for smaller companies versus large ones, the smaller companies, they've got generally like less of an operating history. They're probably a little bit less complex in their operations, which is helpful because there's potentially fewer things that might create challenges on a sort of comparing the two legal regimes to each other, whether it's the cap table or incentive equity or IP ownership or where their workforce is located. Fewer potential, ways in which different legal regimes might create confusion or some extra time to get comfortable. The flip side, though, is you smaller companies are generally going to have less leverage. And so, for example, if a buyer comes in and says, well, laws in my country prevent me from doing a deal that, is the easiest way to do the deal in your country, you may not have the resources to hire counsel in the buyer's home country and challenge that and say, wait a minute, is that really right? You might say, okay, I don't want to hire a second law firm. I'm just going to accept that and find a different way to do a deal. And so you may be playing from the buyer's playbook if you don't have the leverage to kind of push back on that.
Wow, I feel like there's so much to unpack here. We could literally have a whole different session just for this topic. It's just fascinating. And again, going back to AI, it's just changing the landscape. Borders are melting, and there's just going to be so much more international cross-border activity. But given that we are coming close up on time, please, this is for the audience. Keep adding your questions in the Q&A tab. We'll get to it very, very quickly. I'm going to move towards just rapid fire rounds to both of you. This question is for both. If you were to give one piece of advice to founders thinking about a future exit, what would that be?
I'm going to iterate on a message that I tried to articulate before, which is build a business that from the beginning, not a business for an exit, but a business that actually can last independently from an exit or no exit, so that you become automatically attractive very, very old, and you have a roadmap that you can follow prior to an exit. So too often startup spend a lot of time in kind of building a product and running around to find customers, as opposed to logically think about the step to build a solid enterprise, which can sustain initial result over time. And with AI and Gen AI, obviously there is an opportunity to strengthen some of this infrastructure very, very early on at a much, much lower cost that you will be facing in the past when you actually had to hire people to build this infrastructure.
Could not agree more. Again, back to the value, right? It's all about the value. Mark.
Yeah, one piece of advice, I think trying to do, and I know it's hard to carve out time, so I say that fully understanding that founders are very busy people. Trying to do a dry run on what would happen if a term sheet came in today, because a lot of term sheets come in unsolicited and say, well, how would I evaluate that, right? Do I know what a good deal looks like? Do I know how much money it takes to get my convertible loan note holders, my safe holders paid, my preferred stockholders paid? How much money does it take before the common and the option get money where I'm going to feel excited about it as a founder? My employees are going to feel excited about it. You'd be surprised the number of deals where founder says, oh, is this a good deal? I'm like, well, let's run the numbers. And they're like, oh, that's not a good deal. Knowing that's helpful, because if somebody comes in with a number like that, you can say, hey, I'm happy to keep talking, but I'm not going to spend a lot of time on this. I think the other thing that's going to be useful to do is just appoint yourself as Eeyore from Winnie the Pooh, or make somebody else do that and say, what's the pessimistic view of this? What are the existential risks to this business? What keeps us up at night? Is there anything we can do about those? It might be that you could change something that you do to fix it. Maybe it's an area of kind of underinvestment on legal compliance. It might just be a fact of life, right? And rather than trying to fix it, it's what's the best story we can tell to a buyer about why they shouldn't be worried about this. I think it's a helpful exercise, but again, I appreciate founders are busy people, so hard to carve out the time.
That's fascinating. That resonates so much with me, because when I was starting one of my companies, my mentor gave me this exercise very early on, literally, while we were building the product. We had not even started, talking about what the product eventually will be. We just started building the genesis of it. And he was like, write a press release. I'm like, wait, but we don't have a product ready yet. And he's like, no, write a press release of what your product and your company is. And it made me think about so many different things and how I would want to be perceived, or the company would want to be perceived. And I think, yeah, they're just doing a dry run and having all of those things figured out when you have time versus when you're under the gun, I think is brilliant advice. So last question before we move to Q&A. I know we have a lot of audience questions waiting for us. Finally, one key takeaway from both of you: how can early stage founders make M&A's strategy part of their core growth planning and not just their exit planning? I know we've talked a lot about it already, but just one key takeaway.
Obviously, this is a must-have, right? Because thinking about potential acquisition targets, right? So flipping the equation, right, is really, really important, because it's also getting you into the mindset of how you can be seen as an acquisition target, right? And so M&A as a way to accelerate growth does require the focus on at least 3 areas. One is M&A to acquire talent. We said that before, right? In the space of AI and Gen AI, it's difficult to acquire the best possible talent that can actually produce a valuable AI-enabled product. So that could be an option, is to go and buy them. The second one is, and that's been around for a long time, is complementing your technology with technologies that are in the market, as opposed to build your entire technology stack to serve your customer. And often can actually be a much more economical option, especially if time to market is an important variable. And then what we see a lot now, despite political changes, but we still see it as a quite good option, is enter a new market, either for an American company, Asia and Europe, even Latin America, as we see the semiconductor space, right? Or for foreign company entering the vast US market. And as we see a lot of, I'm Italian myself, and there are lots of acquisition cross-border from Italian company into actually US businesses to enter the US market. So these are kind of the 3 areas that could be kept in consideration to improve growth.
Fantastic advice.
Yeah, the only thing I would add to that is it might be useful if folks are able to talk to somebody at a larger company that works on strategic planning, or sort of understand how that works, right? And to sort of flip the script and say, rather than thinking about selling, how do larger companies, especially serial acquirers, think about these things, right? They're thinking about, okay, well, what's our growth strategy? How much of that is things we can do internally, and what has to be done externally, right? And externally could be not because we can't do it internally, but because it's cheaper to buy it, it's faster to buy it. Really kind of building on some of the stuff that Diletta is saying in probably less eloquent terms, but being honest enough with yourself to say, I could build this feature, but somebody's already done it. I think theirs is good enough and it's ready today versus in 6 to 12 months. That could make a lot of sense if I want to if it's really important to move quickly. The other thing to think about too is integration, M&A and integration is tough. It's not as easy as it might seem to kind of realize the value of the companies you've acquired. And so when thinking about M&A, great, this thing works here. Is it going to work in my organization? And doing a little bit of thought process ahead of time. It's not necessarily plug and play. You've got different cultures that may need to mesh. Just different ways of working together. So a little bit of forethought on that front can help you decide if it's really the right deal to do.
Fantastic. I'm just going to add one quick one from a founder perspective. In marketing, we say build it and they will come is a terrible thing to say. You have to get your word out there. But in the M&A world, build value and they will come. I do believe value is everything, but you have to be very strategic about it, whether it's acqui-hire, whether it's your product, whether it's a whole story. Think about the value, from day one, not just from an exit perspective, but value to your customers, right? And then they will come. And with that, oh my God, what an incredible panel. I think there's just So much knowledge that was dropped here today, and we can keep going, but unfortunately, we also need to get to the questions that have been sent ahead of time. So I'm going to hand it over to you, Colin.
Awesome. Well, thank you, Donna, for leading such a great discussion. Mark and Diletta, thank you for sharing your expertise and some of your real-world advice. We have a bunch of questions that are coming in, so thank you all. And if you haven't dropped them into the Q&A box, please do so now. Or as we continue this, we'll try our best to get to them all. All right, kicking us off at the top of the key. For a pre-revenue company with protected IP at prototype stage, would it be easier to sell or license the IP to a strategic acquirer to finish developing and exploit than to look for an acquirer for the company as a whole, since there was little value outside the IP and branding? Mark, I think that one's in your jurisdiction, but Diletta, I saw you came off mute, so feel free to dial in too.
Yeah, a couple of thoughts there. One, I think the question is the license really a sale, right? I mean, if you're exclusively licensing the technology, it's no different than a sale. So it's important to kind of really pay attention to the terms of that license, so that if you're expecting that I'm going to get some value from that license, but I want to stay in business, I want to continue to be able to do other things, that license isn't so broad to the strategic that you're really kind of, done being in business. The other thing I'd say is partnering with strategics can be great. The challenge becomes the more closely tied in you are to a bigger strategic's business, the less attractive you're potentially going to be as an acquisition target for other strategics that are like, well, wait a minute, I don't want to be helping my competitor by buying you. So some thought needs to go into that.
Awesome. Diletta, you came off mute.
Yeah, the only thing I would add is as always, is a business case for everything, right? And I think the devil is more in the details of the kind of offer that you have on the table. Because I have seen plenty of cases where actually just the IP side could originate enough valuation for a good transaction to take place. So I encourage you to really deep dive in the numbers and the opportunity on the table.
Great advice across the board. Okay, another question here. One touch point about buyers using stock. Generally, what are the accounting considerations of giving the buyer the election to pay milestones, earnouts in cash or stock versus hard writing it at closing? Diletta, anything there?
Yeah, so this is a little bit a trend of the past, as we said at the beginning, right? Less and less, I see kind of less and less as the dominant model. And again, unfortunately, it's very difficult to kind of pronounce without really looking at the numbers and figure out what is the best option.
Amazing.
But it's not a preference. It's not something that you can predict in advance, right? Is based case by case.
Totally understand. Donna, I'm going to bring you in here because you have a lot of experience in M&A and also as an LP. Somebody's asking, how do I find a list of family offices that would be interested in being a strategic buyer? Any advice there?
So great question. In terms of where do you find lists, I mean, just go on LinkedIn. I see literally on a daily basis, people are publishing massive lists of early stage investors by verticals, family offices by vertical. I mean, there's just so much data out there. I would say just ask a question on Gemini or ChatGPT or Claude or your choice of Gen AI platform that you use, and you'll get a whole list. The list part, is easy. Like I said, go on LinkedIn, just do a quick search, you'll find one. You can get one on an AI platform or a Google search. But I think the bigger thing is, how do you actually reach out to them? Nowadays, you have LinkedIn profiles for them, you have contact information. That's not the difficult part. The difficult part is really doing your due diligence, right? We talk about due diligence from an investor perspective. You as a founder also need to do your due diligence. Look at which companies these investors or family offices have invested in. See whether you complement or there's already an identical company in their portfolio. How do you position yourselves in that space, right? If you're going to go after that one particular family office. So really understand who they're investing in, how are you related to the products they already are invested in or companies are invested in. And most importantly, build a relationship, right? Don't just say, I mean, cold calling has worked in the past. When I was at Coupons, we actually acquired a company where a guy just cold emailed us and we acquired his company for a grocery application, which was amazing. But those days are few and far in between. Rather than cold emailing or cold calling, I would just really try to build a relationship with that particular family office and then do a pitch. But the biggest thing is really understanding your strategic value vis-a-vis the portfolio they already have today.
So thank you, Donna. Mark, question here for you, I believe. Founders often focus solely on the price in the LOI. Beyond valuation, what are three most commonly overlooked yet binding and non-negotiable clauses within a standard LOI, like exclusivity period, termination fee, diligence scope, that can constrain the founder later and definitive agreement stage?
Yeah, I mean, the binding provisions are generally pretty light. Exclusivity is the main one. Um, and I think the thing to think about is, especially if maybe you're short on cash, right? Exclusivity is basically going to say you shouldn't be doing anything that's competitive with this deal or remotely deal-like, and generally broad enough to prevent you from, raising additional money. And so if you might need some bridge financing to get to a closing, that's one of the questions I always ask people. It's like, hey, do we have at least 6 months of runway? Ideally, 9 to 12, so that we don't run out of money in the middle of the process. And if we do, let's create a carve out so that you can go get a bridge round from your investors to, get you to closing. That's probably the most important binding provision. Sometimes you'll see breakup fees, not super common in term sheets, but they happen from time to time, especially if there's a bit of a trust gap between the parties. The one thing I'd come back to, again, it's not binding, but the price isn't always the price. You might say, okay, here's a $50 million term sheet. Great. But it's going to be, increased for cash, decreased for debt, increased or decreased for working capital based upon an agreed upon target. There's a lot of, each of those terms is going to have a definition that's like a third of a page. And so things like if you have a lot of deferred revenue, for example, if you're not familiar with what that is, again, AI, super helpful. But if the buyer wants to deduct all of your deferred revenue and you've got a significant balance because of the way your business operates, you want to know that up front, right? $50 million deal, $5 million deferred revenue balance, suddenly it's a $45 million deal, and maybe it's no longer attractive. And so trying to get into the details of that, talking with your advisors about that before you sign the term sheet. Again, I'm repeating myself, but it's such an important stage to try to flesh out some of those key details.
Awesome. Thanks, Mark. Diletta, I think I have one for you. What's the optimal strategy for a smaller company to prepare a data room? Should it be a dump everything approach or highly curated stage release? From a buyer's perspective, what's like the one thing that they red flag during the diligence that makes you question the integrity of the deal room and kill the deal?
Yeah, so my approach is a little bit atypical, which is building trust early on in the transaction, especially if you're building a data room. Obviously, you are in the process of diligence. It's not just intent. It's actually both parties are committed to proceed with the deal. So the approach I would suggest is the data dump, but at the same time is the security access around it. These days, you can build a very sophisticated data rooms with a very multiple layer of data access where you actually control every time the data are touched, but also are manipulated or change. And then lastly, what was the second question?
Oh, it was around like what are the red flags that buyers could potentially see in the data room that
Yeah,
may kill
is
the deal?
when I always seen issues around revenue, and so discrepancies between some of the metrics associated with churn, long-term value, and customer acquisition, and the actual revenue and booking numbers. So those are red flags because ultimately, if those are disaligned, then obviously the top line value may be overstated. And then also in terms of the cost structure. so the footprint. And if there are discrepancies, then obviously require deep dive. But the beauty is, again, not to go back to the usual topic, but with AI and Gen AI right now, it's so much easier to flag very early on discrepancies between metrics and financial, and then provide a quick overview of what need to be deep dive in the course of conversation during the diligence phase.
Amazing. Great advice. Donna, I'm going to kick it over to you since you've been in this chair a few times. If a founder is looking to be or wants to have acquisition conversations in the next 18 to 24 months, what should we be doing now?
That's a brilliant question. So many things. And again, preparation is everything. I think at the very onset, I would say, again, we've talked about this many, many times. You're not just doing something for an exit, right? Don't ever do that because that's not the right strategy. Build value, build value, build value. But in terms of how to prepare for that, once you feel like you're ready, we've talked about really, having the right conversations, start sending feelers out. If you don't have inbound interest, you can start sending feelers out. You can figure out, do you want to go after a family office? Do you want to go after a PE? There's so many different types of acquisitions you can go after. You can hire experts. I mean, not you can. I feel like you should hire experts. And I think Diletta mentioned that, as did Mark, that both their firms work with very early stage companies, which is music, right, to a founder's ears. So start really early. It doesn't have to be a huge involvement early on, but talk to experts so that you know who the right targets are. And typically when I work with founders on acquisition, I have a full questionnaire that I put together, and I'm happy to share that as well, in terms of what your value is, what you think your value, the perceived value. You might think there's 16 different product lines. Which one do you think is the most strategic for which kind of buyers? Really starting to think about who the buyer is, which of your product lines is the right one for acquisition, and then how do you start having those conversations, and then start making those steps, advances towards those conversations. Start with like warm outreaches, just trying to like get feelers out, and then work with experts to really then go full throttle, as you prepare deeper into the process. But the whole thing is about just prepare early and like just follow the steps all towards that exit.
Amazing. Thanks, Donna. All right, we're almost at time for our break, but we've got one. Given that we've talked so much about the heated up AI M&A environment, there's a question here. Do you have any advice for companies with proven technology but require more development before market entry? And looks like they are looking to be acquired now due to their IP position. Diletta, Mark.
So they have the technology,
And it
but
just requires a little bit more development,
go to market.
but it's definitely a strategic advantage, it sounds like.
Well, to just have technology without customer is not a good idea, and that's typically the pitfall, right, of the founders that are technologists, that are product people, right? So you fall in love with the product, but if the product doesn't have a market, then obviously the value is difficult to realize. So I think to hire salespeople that understand the product, that have the right connection in the market, and enable some sort of sales of the product, or licensing or leasing, or renewal of existing contract, I think is a must-have.
Awesome. And Mark talked a little bit about that.
Yeah, I agree with that. I think there's a sort of a non-obvious reason why it's a little bit tougher, right? Because so much of small to mid-sized tech companies are acquired once a buyer reaches out to them, right? Because you've got PE firms and you've got strategic buyers that are routinely scouring the landscape for the types of companies they want to buy to kind of match their growth strategy. So they're constantly looking. If you're in a phase where you're developing the technology, right, but maybe there's not as much press out there because you're not routinely, doing customer deals, having as much marketing, you may not be on folks' radar. And if you're not, it can take a little bit longer to have that percolate internally at potential target or potential acquirers to buy you. finding some way to kind of get out there and try to do some market activity, I think will be helpful, not just to validate the value, but also to raise awareness that your company is out there and a potential acquisition target.
Yeah, and just one thing I'm going to add there, and this is again, something that you should be doing as a founder. Just have a lot of thought leadership, presence, and pieces on LinkedIn. That is where investors live and read. Even though there's a lot of noise out there, just start, building that super early. It doesn't take a lot, even 18 months in advance. Start doing a lot of thought leadership pieces, build your dominance of expertise in that space. And if you're going to do that tomorrow, you should already be doing those thought pieces right away, like today.
Awesome. Well, what a way to round out our early stage panel. Thank you so much, Donna, for leading the discussion, Mark, for sharing your expertise, and Diletta for joining us today and just sharing all of the upcoming things for everyone's M&A brains out there. So thank you so much for the time today.
Thank you.
Thanks, Colin.
Thanks.
All right. Well, for our attendees, we're going to take a quick 5-minute break, and then we're going to transition into our next panel of growth through acquisition, buy-side overview and insights. So go refill your coffee cups or tea, and we'll see you in 5. Thanks again, everyone. All right, all right. Welcome back, everyone. Please join me in welcoming our next panel to discuss growth through acquisition, buy-side overview, and insights. Just a quick note, our moderator, Roberta Burrows, had a scheduling conflict, so I'm going to be filling in as our moderator today. But joining us in this panel is John Milner, partner at KPMG, and Brendan Mahan, partner at Wilson Sonsini. Brendan, John, welcome.
Morning.
All right, well, before we dive into the discussion questions, I'd invite both of you just to give a quick introduction, other than just your name and title like I just did, and your side of M&A today. So Brendan, maybe I'll start with you.
Sure. Good morning, everyone. My name is Brendan Mahan. I am a partner in the Mergers and Acquisitions group at Wilson Sonsini. We're an international law firm, but with our headquarters and roots in Silicon Valley. My personal M&A practice is pretty diverse. I think I probably have a fairly even mix between buy side and sell side clients. So I think I can hopefully give you a pretty fair perspective of both of those sides today. I do deals of all sorts of sizes and targets in all stages of development. Perhaps the only part of my practice that's not so diverse is my clients tend to be in the tech space with a little bit of life science sprinkled in there as well. But even my client base is somewhat diverse. So I'm looking forward to having a conversation with you all today.
Awesome. Thanks, Brendan. John.
Yeah, absolutely. John Milner. I'm a partner with KPMG's deal advisory practice. And so I help my clients execute M&A transactions through diligence and through value creation. Much like Brendan, like my client base spans private equity, corporate, a lot of technology, and various different sizes, from small startups to the largest tech clients out there. So super excited to be here once again.
Amazing. Well, it looks like we have the right panelists for this discussion. And just to set the stage, we're hoping to cover some of the, some of the advice for founders and executives to understand how acquisitions can be used as a strategic growth lever, not just as an exit, and what both sides should know in today's evolving market. So let's just start this off with a general question to you both. John, I'll start with you. How would you describe the current M&A landscape for mid-market companies, and has the tone of the buy-side activity changed over the last 6 months?
I think it has changed over the last 6 months. And I'll talk a lot about my conversations from a sort of a technology lens, because that's a sector that I spend a lot of time on. And I'm guessing it's probably the sector that a lot of people in the audience spends time on. But as we think about the first half of 25, it was tech really led the way in sort of an M&A rebound. And as I think about Q3, tech has continued to increase in terms of deal count as well as deal value. We're certainly seeing a lot more activity, and it's picking up. I mean, just over the last handful of weeks, our practice is much more active than it was, say, a year ago in terms of the M&A transactions. And that's mostly driven by more buyers looking at better assets that are coming out to market. So it's been definitely a marked change from prior conversations in terms of where the market is, and hopefully that continues.
Awesome. And Brandon, how have you seen your desk change for mid-market companies and the buy-side activity over the last 6 months?
Yeah, I'd echo John's comments. And I also like the question for the focus in the last 6 months, because I'll say occasionally we get founders, investors looking longingly back at the boom of 2021 and kind of wish we could return to that sort of super busy hot market. Maybe we're trending towards that, but I think by many metrics, 2021 was probably the busiest M&A year ever. So kind of looking at that as a metric opposed to kind of how is the last year and the last cycle, I think is probably not the right perspective. But to actually answer your question, I do agree with John. I mean, I think, earlier this year, I would have said there was, a shift towards buyers being much more selective and disciplined, but things now I think are definitely starting to pick up. The tailwinds are definitely suggesting towards the market becoming hot again. And I think early mid-market companies are in a great position because they're actually at the center of a lot of the action. And I think a lot of the activity has pivoted to them. So I think it's, I think in terms of the recent tone, I'd say it's become definitely more optimistic compared to 6 months ago. And there's reasons to think it's going to continue to trend that way.
Amazing. As our market update showcased earlier this morning. John, over to you. From KPMG and your perspective, what's driving buyers in today's environment? Is it cost synergies, market expansion, technology? We've been talking a lot about AI for most of our discussions today.
You can't not talk about AI. Technology and everything AI is certainly driving a lot of the market. But as I think more broadly about where the market's happening from a buyer's perspective today, there's kind of a couple different dynamics. On the one hand, you've got more quality assets coming to market. As I talk to the buyer universe that I work with day in and day out, their biggest challenge over the last year, 2 years has been just the lack of quality assets that come to market. It's not that they haven't wanted to transact, there just haven't been companies coming to market that are very interesting to transact. And like Brendan mentioned, people look back to those elevated valuations of 21 and 22, and we're just not there. And so there's a little bit of sort of bid-ask spread. I think a little bit of that is changing today, but we're seeing more quality assets come to market, which is helping buyers get more back into the rhythm. And then if I think about it, like, secondly, investors still love the scalability and the TAM behind the technology assets of what you can buy and what you can do with it from a value perspective. But I think that mindset has changed. It's changed from a growth at all cost mindset to really a measured growth around profitability and what can we do. And that's for the scaled assets that are actually generating returns. There's still a lot happening around new technology that is just finding its product market fit, hasn't fully ramped, but is showing those signs and the traction. There's still a lot of activity around that sort of an IP transaction to fill out a technology play.
Great. And Brendan, on the legal side, you were talking about how everyone's walking back to 22 to those days, but how have deal structures evolved post 23? Are we seeing any more creative financing, earnouts, or alternative structures as capital costs rise?
Yeah, I mean, I think we definitely are, and as John mentioned in answering the previous question, I think the valuation gap is driving a lot of that, and so I think we are seeing a rise in contingent payments and earnouts and things like that, just as a mechanism to bridge valuation gaps. I wouldn't say that's by any stretch something you see in every deal or necessary to get a deal done, but I think that's just when you just simply don't have an agreement on sort of what valuation you should be using. That's an easy tool to bridge that gap. A buyer can say, all right, if you hit your projections, then you get this other payment, and if you don't, then you don't, and that protects the buyers if things don't pan out, and protects the sellers if they can execute on their plan. I think that's particularly something you see in certain sectors like biotech, when the value hinges on achieving certain milestones. It can also happen a lot in tech when launching particular products is going to be a huge driver of value, but it's prevalent in all sectors, I think, to some degree, when there's skepticism on projections being real, frankly. I think one thing that's kind of interesting that we've seen recently in the AI space is that, I think we used to think of, or at least what I used to see, was acqui-hire as being a tool you'd often see for smaller companies and perhaps struggling companies. But I think now you see them, sort of on all levels of companies, struggling or not struggling, and companies of all sizes, where there's this rush to kind of absorb that talent. So that's certainly, I think, an alternative structure that we're seeing much more now as part of the AI boom. So I think, in short, yes, I think deal making has needed to become more inventive. I don't think the market's such that you need to be super inventive in every deal to get a deal done, but it's definitely a tool that's often used to bridge gaps.
Awesome. And speaking of projections, I guess we're going to go for a prediction here, but follow-up question to you both. John, I'll start with you and then roll to you, Brendan. Do you expect the end of 25 and 2026 to be a buyer's market? And if so, what does that mean for founders who might one day be sellers?
Yeah, I'll get my crystal ball out and shake it. I've been really good at that for the last couple of years in terms of predicting. So put whatever faith you want to have, maybe very little in what I'm about to say. But I think it's actually a little bit different. I think it's a seller's market right now, and I think it's going to continue to be a seller's market for quality assets. And I think there's this really big divide right now in the market between the quality assets that are coming to market, which are having immense competition I'm seeing 10 parties or plus showing up at auctions for these companies. There's huge demand for very high quality companies. And then there's a lot of companies that probably shouldn't be coming to market, but for one reason or another sort of have to. And there's a lot of failed processes there. So I think it's really a seller's market for the higher quality assets. It sort of has been. I think it's going to continue to be. There's just so much pent up demand as you think about what's in private equity in terms of their capital that they have to deploy, that they haven't deployed. They're desperately looking for assets to go buy. The corporates are always looking for assets that fit the right niche. So again, I think it's going to be more of a seller's market. And so if you're a founder looking for an exit and you've got a very attractive business, I think it can be a very attractive time to transact.
Great news for our entrepreneurial community
Yeah.
up there. And Brendan, I know you were on the market update, and John mentioned the $2.3 trillion of dry powder out there. Any insights into the end of 25 and 26?
Yeah, my crystal ball probably works not as well as John's, but I think that's probably right. I mean, I think there's lots of dry powder out there. I mean, I think again, if people are looking back to the 2021 highs, you might say, well, this looks like a buyer's market because that was just a crazy seller's market by kind of any metric. But I think realistically, when you're looking at companies that are have an interesting product, have that key asset that people want, it really can be a seller's market. I think what we are seeing though is in sell side processes, there aren't always as many bidders coming to the table, but that's certainly not going to always be the case if you really have that hot commodity asset, and there's always ways to get competitive tension in the process, even when you have less people coming to the table. And I mean, I think maybe just for one silver lining to maybe pile onto the optimism, even if you perceive it in some ways that it's going to be, that there might be some elements of a buyer's market, even then, I think what that means is that buyers are actively looking for strategic additions and they still have their eyes open for bargains, if you will. So if you can position your company as a solution to a problem, whether that's a tech gap, a talent infusion, something like that, I think you can still spark a great acquisition interest, even if the market turns to become more difficult.
Yeah, that's great. All right, so we're going to start at the beginning of this, and then we'll roll all the way to the end of some of the later stage stuff. But on building a buy-side playbook, John, for mid-market companies, what's the first step for a company thinking about growth through acquisition, and how do you start identifying the right targets?
Yeah, I think before you even start thinking about targets, it comes back to really why are you doing a transaction? You've really got to understand and think through what is your strategy? What are you marching towards? And then how do you get there? And every company is sort of looking at where they want to be and then deciding how they get there. And is that a make or buy decision? Is it a technology aspect that I need? Is it a market, a geography, or a certain customer segment? Or do I need certain customers in order to validate my product or the like? Or do I just need new products because I've got a bundle strategy? And so the more products I attach, the more sticky I am. All of the various different strategies, you got to really understand that. And then you use M&A to fill in the holes. I mean, Brennan kind of mentioned it just in the last answer here, which is like, buyers can be really picky and find the right assets to fill those holes that they need. It's very much a strategic question of like, what do I need to do? And should I make it or buy it? Is the time to market so much faster through M&A that it's worth all the disruption, the cost, the expense, the hassle? It's not a fun process for a lot of people, even though we make it out to be a little bit of a fun process. So I'd start with the why. And then once you sort of know that and you are going through your make-buy decision, then you can start identifying the targets. And I would say everybody should have that list of targets that they're interested in that would really help accelerate that growth and execution of that strategy. And then start the conversations, because there are so many transactions that happen outside of a formal sales process that just start by a relationship between founders or executives at the company that start talking about what is the art of possible and what does 1 + 1 = 3 or 4 happen. So start there.
I love that, John. Very Simon Sinek of you, of starting with the why. Brendan, when you represent buyers, what are some of the most common issues that surface during diligence? And how can early stage founders prepare for those?
Yeah, so that's a great question. I think it's kind of interesting because the same issues seem to come up, frankly, almost all the time. So, or at least a handful of them do. Every deal is different, of course, and there's different issues in every deal. But I'd say due diligence is an intrusive process. And so if there's skeletons to be found, they're probably going to be found. And there are a few ones that pop up quite regularly. I'd say the first one I kind of just put into just sort of legal paperwork and housekeeping, frankly. And you'd be kind of surprised how often a very promising startup full of really smart people just has really messy records. I mean, maybe your financial statements aren't up to snuff. Maybe your cap table has a bunch of unsigned option grants, or you promised equity to some people and you haven't actually dealt with it. And sloppy records just don't look good from a buyer's perspective. And frankly, at some level suggests, if you're cutting corners there, where else are you cutting corners? And how can we trust you to do something complicated if you haven't proven you could do something basic? So I think those optics matter, and those are really easy things to clean up that founders can take care of, as uninteresting as it may be to do. I'd say more on kind of the substantive side, IP ownership is a huge one. With tech companies, almost the first thing you look at is, okay, do you actually own the IP? Are your invention assignment agreements robust? Do they work in local jurisdictions if you have, ex-US jurisdictions? If you use a consulting firm, do they actually give you all the IP? If you're buying the IP, just making sure you've done that in the most robust way possible, I think is really key. I think just taking a step back, I would say, founders can probably save themselves a lot of headache by just thinking, like, what would a buyer want to see? Like, if you can proactively tackle those things, it's just going to be a lot less painful. And if you show that you have an organized process and system and company, that just, I think, builds a lot of trust. And at some level, buyers are going to be willing to pay a premium for well-run, organized companies, and kind of proving that you are one of those is going to serve you very well.
Yeah.
Yeah, and maybe if I might just add on one other point if you're a bot on the buy side, like one of the traps that I see happen, especially in some of the early stage buyers out there, is they get really emotionally attached to the transaction, despite a lot of red flags that come out during diligence, and they start making the wrong decision. And so I caution people not to get too emotionally wrapped up in executing the deal because they want to get a deal done if it's not the right one.
Yeah, that's great advice. And switching gears a little bit to beyond financial fit, how much weight do buyers put on cultural or operational alignment? And I know we have all been talking about the smaller AI teams that are getting into these M&A deals, but yeah, John, what are you seeing there?
By and large, I'd say world-class acquirers, buyers really care about cultural fit, at least in the world that I tend to play around technology. Culture trumps kind of almost everything else. Tech debt you can replace. IP, yes, is very unique, and so sometimes it's very much an IP transaction. But when we think about sort of operational aspects and whatnot, I think those are much less important than culture, because by and large, we're acquiring people, and we want those people to 10x the business or whatever that particular area is. And so making sure that that's the right team and that culturally they're going to mesh with you. I think we've all probably seen some of the shows around cultural mesh and how that plays out. You got to really diligence that. And I see a lot of buyers focus on financial diligence, tax diligence, legal diligence, IT diligence. And HR seems to be kind of well, did we tick the box on the payroll and the benefits, like very much compliance? But I think the really good buyers do cultural assessments. They really think deeply about how those people are going to integrate into their business, how they're going to incentivize them and retain them, and how they're going to get the most out of it. Because again, a lot of buyers will actually use an M&A transaction to transform the rest of their operations. And so as we think about what's actually happening in the background becomes less important. The paper the contracts are on become less important. It's an issue to deal with, but it's easy. The vendors are easier to deal with. It's really the people. I think people are incredibly important, and we get too lost in spreadsheets sometimes.
Yeah. Brandon, any cultural or operational alignment advice from the legal side?
Yeah, I mean, I echo everything John said. I mean, I think it's becoming increasingly the focus for at least sophisticated buyers to look at the cultural fit. And I mean, just, particularly if you're acquiring a company in large part for its talent, will the key talent stick around? Do they want to? And if the answer is no, buyers either adjust the price, figure out how to retain people, or simply just pass on the deal. So, I mean, I do think the cultural and operational alignment, and the cultural one in particular, is an increasing focus. And I think sophisticated buyers are starting to do the due diligence on that earlier rather than later now, just because they realize if you go too far down the path and you realize there's a complete culture clash, it's just not going to work. You should figure that out sooner rather than later.
Totally. And to switch a little bit gears from my plan questions, are there any like risk integration, value creation challenges that arise after closing, especially for early stage acquirers, John?
Yeah, I think a tremendous amount. I think especially you really sort of have two sets of acquirers, I would say, in the universe. You've got incredibly well mature, high velocity acquirers. They have a playbook for everything. They're executing 10 to 20 transactions a year. They've got entire teams. It's a well-oiled machine. They know exactly what to do. Their teams are aligned. There's a playbook. And then you've got everybody else that may do 1-2 transactions in a lifetime. And unless you have had a really great set of advisors helping you in the pre-closing period to think through all of the integration plans, what really day 1 and day 100 and day 1000 looks like, there's going to be a lot of unexpected areas. And it's going to come up. It's just going to be putting out fire drills constantly in those first 1 year sort of periods around integration. It's going to be people matters. It's going to be customer matters. It's going to be IT matters, vendor matters. So the more planning you do, the better off you're going to be at the end. And I see a lot of companies looking at it and saying, I don't want to put that much effort up front because I don't know I'm going to get the deal. I don't know that I'm going to sign it. I don't want to invest all of that time and resources in doing that planning. But I think that leads to a very suboptimal outcome, because really the post-close period should be focused on value creation. How do I get to an integrated state? How do I fill that strategic gap of why I bought this business? How do I go fill that versus how do I start putting out all the little fire drills, which are really value destructive? They are just distracting. They take time and money, and it's not what you want to be doing.
Yeah. Brandon?
Yeah, I just to pull one thread that John was speaking about, because I agree with everything he said. I mean, I think the key is resource strain, frankly. And so I think if you have serial acquirers that have sophisticated teams, they will often just have integration teams. Like that's all they do. And so in terms of distracting time from management and other people, that just doesn't exist very much. But if you're an early to mid-stage company and you're acquiring another company, you're not going to have that integration team, and it's probably going to fall on senior management to do that in addition to their day job. And that can be a real pain, and just prevent management from actually executing their own plans. So I think having a really well-run integration plan is particularly important when you're going to be resource strained. You're going to have to do your day job too. You don't want to be spending your whole day as a CEO integrating the company and thinking about what to do just because you're caught off guard with how challenging it is.
Mm-hmm. Great point. And John, you talked a little bit about due diligence, but what does it play in the post-close success, and how can teams ensure what they're buying actually delivers what you were talking about, the intended value?
Yeah, it really comes down to doing all the proper diligence up front. I mean, diligence can, again, look like something that we should minimize. And you're seeing in a lot of processes, the sell side being competitive, trying to minimize access and the ability for people to do diligence because they don't think they need to give that access. I think doing that diligence is incredibly important to minimize the disruption post-close. I mean, what Brendan said, is absolutely true. Like the disruption that an M&A transaction causes is massive. And so doing proper diligence, having the plans to minimize that, to focus on value creation is probably the most important thing you can do. We can all argue about small numbers on a spreadsheet And yes, that means value here and there, but really it's about what happens after close.
Totally. And Brendan, when it comes to like legal counsel, how early should legal counsel be brought into the buy side process? When should people start talking to you? And what's the most common mistake buyers make when they wait too long to talk to you?
Well, of course, I'm very biased in this answer, I suppose, but I'd say bring in counsel as early as possible. I'd say ideally at the strategy stage, even before you approach a target. I mean, while I will say there's a lot of paper to push in an M&A deal, and good lawyers are good at pushing paper. Really good lawyers aren't just paper pushers. We're also your strategic partners, and we can figure out potential deal killers. We can figure out if there's gaps in understanding in the term sheet where you don't really have a deal. I think we can also just align expectations on timing, because there might be an antitrust or regulatory angle no one's thinking about. And you may promise to your internal executive team or even the target, hey, we're going to close on this timeline, and then all of a sudden, you call your lawyers and they say, hey, have you thought about antitrust, or have you thought about these licenses you need to transfer? And it's not going to be as quick as you think. And I think having those conversations before you kind of box yourself into false expectations is really key. I think we also just help with structuring the deal differently, making sure it's the most tax efficient way, which can kind of have a knock-on effect for the rest of the transaction. But I would just say, I think, involving counsel early is cheap insurance, or at least relatively cheap insurance. I think it doesn't take a whole bunch of our time up front to give you advice as a strategic partner in how to structure things and just kind of what a transaction looks like. And I think I've never heard a client really regretting looping in their counsel earlier, but I've heard a lot of regrets, with people signing term sheets and then bring it to their counsel, and then we start asking questions and they realize it may not be as simple as they thought.
Yes, I've heard the term from many folks on both of your teams, pay a little upfront to save a lot of pain and money later.
I think that's right.
Yeah. I've never heard, just to echo from a non-lawyer perspective, no one has ever complained about getting legal involved too early in an M&A process, but they always complain about it coming out later. Like, it is true.
Yeah. John, talking about evaluating acquisition targets, you mentioned understanding the why at first, but what factors make a company most attractive for a buyer? Is it metrics? You talked a bit about team, IP, a mix of all of them, or something else?
Yeah, I think it really depends upon the why. I think every why has a different set of answers there. Sometimes the team is incredibly important, the only thing that matters. Sometimes it doesn't matter at all. Sometimes what really matters is the metrics around the product and how is it selling, what is its ramp, what is its retention, and because it's really a sort of a product element to it. So I think you just sort of think about the metrics about why. But whatever the reason is, what you look to should always be leading edge. If what you're buying isn't raising your bar, you probably should really consider why you're doing that, because that's just going to pull your average down. You should be buying world-class, best-in-class, unless there's a really good reason not to. And maybe it's something super distressed and we're just picking it up because it's almost free, and that's certainly a strategy that is different, but that's not the most common strategy.
Yep. And I think Brendan may have a bit more on this, but because you talked a little bit about this earlier, but from your experience, where do most deals go wrong, get lagged, take the most time? Is it legal? Is it cultural or operational?
I would say usually it's not legal. Maybe that's just me saying that, so it's not the lawyer's fault. But no, I think most deals aren't really blocked for legal reasons in my experience. I mean, I think outright legal deal breakers, like say your transaction's blocked for regulatory reasons, are relatively rare. And when it happens, it should be something that your counsel flags to you as being a possible thing way in advance. So even though it may be a bummer when it happens, it's not a total shock that it happens. I'd say instead most deals go wrong because after you've signed the paper and after you've closed, because most deals that sign do close, integration goes poorly. There's cultural misalignment, which I know we've talked about before, or operational misalignment. So I think those are issues that really should be addressed and discussed before signing, and try to ultimately mitigate before closing. So, of course, like legal, culture, and operational, like everything is intertwined in an M&A deal. But I'd say most deals fail from a combination of cultural and operational clashes.
Yeah, great advice. Let's see. John, to pull a little bit off the thread of what we were talking about in our early stage panel, but I think it's helpful for this one as well. Suitors have a hard time with the concept of earnouts based on a company's latest ARR, right? There could be a pause. How do you overcome this barrier when the tech is clearly needed in the industry for the buyer and is far superior to the incumbents?
I think there's probably a couple questions in there. When we think about earnouts, just in general, like I'm not a huge fan of earnouts. That may be different to other people. I do think that they are one way to sort of bridge value, and especially if you've got a buyer and seller that are very divergent in terms of what they think the value of their assets are, whether it's highly successful, medium success, etc. I think earnouts, especially when they move into areas that get combined, become almost impossible to track and manage. So when we think about earnouts related to ARR, and if we're combining technologies or we're bundling, like you introduce so many areas for the parties to dispute, that what ends up happening is either the buyer just pays the earnout because they don't want to deal with the dispute, or they've changed strategically what they want to do with the business or the product or the asset. So the tracking is no longer there, or you end up in a really protracted and expensive and distracting dispute with the other party over what the numbers are. So I think if you are going down the approach of earnouts and other sort of metrics, like, and Brendan, I'm sure, has some very real world experience here and stories to tell us, but like you got to be really clear on what you're measuring. And I think when you think about ARR, you're typically integrating that into something else that becomes very hard to track.
Yeah, if I may, I think that's very well said, and I think, I mean, earnouts definitely are rife for dispute, and they're very painful to negotiate. So I think they are a very, very useful tool if you can bridge valuation gaps, but they're not a one size fits all, and people should go in them with eyes wide open that, defining what ARR is, defining how that works when the products are integrated, like that's actually really complicated. And what obligations does the buyer have to, if any, to fulfill that? And I think just, acknowledging that it's a tool in the belt, but it might be a painful one to use, and it might be a lot simpler to not use it if you're able to, even if that's a tool that you can use if you have to.
Great. And Brendan, just to stick with you for a second, as we're talking a little bit about the founder's side to be better for the buy side, is from a legal perspective, what can founders do today on the sales side to make their company more quote unquote buy ready for future acquirers?
That's an interesting question. I mean, I guess maybe the thing I would say is maybe just do a dry test run now. I mean, if you were in a diligence process now, are you ready right now? Do you have your key agreements all buttoned up and in an easy to located place that you can put in a data room? Have you protected your IP? Like, go through the questions of what a buyer is going to be focused on, some of which we've talked about before, and just ask yourself, kind of, have you done those things, and kind of do a dry test run, if you will. You can also engage your advisors, of course, too. You can say, hey, if you were going to acquire me, like, what would you do, right? What questions would you ask me? What diligence list would you ask me? And like, just be ready to answer those questions and see what those questions are. I'd also say maybe this is just a basic thing, but address your liabilities and your skeletons in your closet now, because those things are going to come up in diligence. And so if you have a potential lawsuit or a regulatory compliance issue that's out there impending, you don't have to like settle that lawsuit to be buy ready, but you should have an explanation for it. Here's what it is. Here's what the risk is. Here's why you shouldn't be scared about it. And just don't think you can sweep things under the rug. I'd say the last thing maybe is just, founders can do a lot just by being, easy to work with in an acquisition. And I don't mean rolling over on terms, but I mean just like having a process. Like if you got a term sheet today, what would you do? Like who do you need to talk to? What's your governance process? Like what is your board meeting and investor communication going to look like? And kind of how would you approach that? So I think all of that is to say, I think just doing kind of a dry run of what would happen if you're in a buy side process could do a lot of help and just get you ready for it.
Yeah. And John, I
Let me just add on.
Yeah, of course.
1 second there. What you're seeing today in the market is, especially for people that are going through the sort of the sell side process, is they're doing a lot of pre-sale, what we call pre-sale diligence. To Brendan's point, like getting ready, like they're getting everything ready. They're doing the pre-sale financial diligence. So they're actually going out to buyers and saying, we've engaged somebody like a KPMG to go do diligence, and here's their report, and here's the tax positions, and here's the IT positions, and here's the HR positions. And what that does is that makes the whole diligence process much smoother, because now you've laid out the story, you've told it, you've put everything together, instead of having all the different parties asking you for the same thing, but maybe slightly differently. You're more control of the narrative.
That's great. And that's some advice for our founders that have dove into the buy side panel to learn what's going on the other side of the table. To go back to the buy side, if you could give one piece of advice on a buyer managing the first 100 days post-acquisition, what would it be? Brendan?
Yeah, I mean, so that's going to be I think the key to success, frankly, and whether or not your acquisition is successful. I mean, I think I would say develop a plan in a detailed one, and not only execute that plan, but try to do it with some flexibility. So you might say, by day 30, I want the product teams to be working together, or I want these systems to be integrated. But I think having a detailed plan like that is important for success. But I think also, being able to course correct. So maybe a key employee leaves on month 2, and just being able to pivot and be flexible if the unexpected happens, just so you can continue to show momentum. So I think probably those first 100 days are the most important. I'd say the other thing, which I know we've touched on before, but just don't keep your eyes off the cultural aspects. I mean, when you're integrating teams, small resentments can fester if not dealt with quickly. But I'd say essentially just treat the first 100 days of a project on its own. You're not just managing a business, you're kind of managing a marriage of 2 businesses then, and making sure that that's going successful, and that you have a plan that you developed before the closing.
Yeah, John.
I think that was very well said. I agree everything that Brendan just said. Planning is incredibly important. I think the piece that I would add to it is maybe more of be humble during the time. You are going to learn so much in that first 100 days that you didn't know, that you didn't find out in diligence. Things are going to come up. You're going to have problems. And it's really easy to start finger pointing and who didn't know what and who didn't say what. But the point there is you've got to move forward. To Brendan's point, it's a marriage of 2 businesses. You are where you are. Figure out how to drive the most value here, and kind of go with those punches.
That's awesome advice. To go back to some of the things that the first panel was talking about with regards to AI and the ecosystem there, some of the companies that these buyers are looking at are smaller teams than previous M&A targets. So what are you seeing around that? And is that affecting valuations or any of this cultural integration that you all are talking about? Brendan?
Yeah, so I guess is this focused on generally, or the AI space?
AI space, but I mean, even all of the companies that are AI enabled are also, you're seeing this much smaller teams getting acquired for high valuations.
No, I think that's definitely true. I mean, I think we're definitely seeing a large focus on talent acquisition in the AI space in particular. And so a lot of companies are being acquired who are, AI enabled or in the AI space, very early stages, maybe even sometimes before they even have a product, just because it's really about acquiring the talent more than anything for some companies. That's obviously not universally true for all AI companies, but I think many of them, even at the early stages, it really can be just a race to acquire as much talent as possible. And so you are seeing companies paying for that talent. And the valuation question there is interesting because you're kind of valuating it for the talent at some level, right? So like, what does it even, an earnings multiple might not make sense if you have a startup that was founded 3 months ago and it has a website, but you have the best PhD AI engineers in the world. That's sort of like, I don't even know what the valuation is other than what are you willing to pay for the talent. So I think that's definitely something that we're continuing to see, just that race to acquire talent.
Yeah, awesome, John.
Yeah, I agree. It's a race to acquire talent, which I think makes the question that needs to be answered around how do you culturally manage this talent? How do you bring the teams together? Because in previous transactions, especially when you think about more buying businesses, you've got a typically a larger workforce. It's easy to lose 1 or 2 people. In a lot of these transactions now, 1 or 2 people is the entire value of the assembled workforce that you're buying. And so you've got to be really focused around what is the retention and incentives of those handful of key people, but also the rest of the team, because it typically isn't a very deep team. They all have their superpowers and are very important, and losing any one of them becomes expensive. And so that cultural fit, the alignments, and the retention become critical.
Yeah, and some of those early stage companies may not have access to or have had exposure to large corporate environments, right?
Yes, very fun when they get to do their first expense report and it
Yeah.
gets kicked back 6 times.
Yeah. All right, well, we're coming up on live Q&A, so if you've got any questions for Brendan or John, drop them into the Q&A box at the bottom of your screen. And we have a bunch of pre-submitted questions that we can get to as well. But to round us out in closing to you both, and I think we've covered a little bit of both of the sides of the M&A equation during our talk, but how can founders use M&A strategically, whether buying or preparing to be bought, as a growth accelerator rather just than this exit? Brandon?
Yeah, no, I love that question because, reframing M&A as a tool for growth rather than just the be all end all, I think is the right way of looking at it. I think a savvy founder can do something, on a smaller scale on the buy side as well. Maybe you can buy a company that has a feature your product's missing. I think the key there is to be strategic. I think, I think a buyer should be asking themselves, will this deal help us grow faster and more efficiently? And to really have a value-driven strategic approach to things. And I think as a seller, you should think about, does this really genuinely enhance the story of your company? I think the most successful deals I've seen are, where founders are asking themselves, how does this fit into the picture as a whole? How does this help the product grow? And just looking at it as the next stage rather than the end.
Great. John?
I don't know that I have much else to add to that. That was incredibly well said. I think it comes down to the strategy and how this particular asset either helps you grow or helps somebody else grow in answering that question.
Yeah, perfect. All right, well, we're gonna jump to live Q&A, so drop those questions in the box, and I see there's a bunch coming in. Let's see, up first, and feel free to come off mute or jump on for either one of you if you have an answer to it. But how important is the involvement of M&A integration leader during the transaction?
Yeah, I would say, incredibly important. If you've got an M&A integration leader, like there should probably be involved from day 1, day 2 of thinking about this asset of how are you actually going to bring it together. You can't do enough integration planning before you sign and close a deal. You just can't.
Yeah, and we talked a lot about the culture
Yes.
during this.
Yeah,
So
I wholeheartedly agree, and I think sort of you're in a lucky position. I think compared to maybe many early and mid-stage companies, if you have a dedicated integration planner, I think that can just take a lot of the resource strain issues away from senior management who might otherwise have to deal with that. So I think involve them as early and as frequently as you can.
yeah, awesome. Another question here, and it's a long one, so bear with me, fellas, but We're a public company. We buy about 2 companies a year. We spend so much time on indemnification provisions in the lead up to signing, but in 10 years have actually never made an indemnification claim. We're probably about to make our first one soon. How painful and relationship breaking with the sellers is it actually to pursue and win a claim? And in this case, we can deduct our claim from the next earnout payment. Any tips?
So maybe I'll start. I mean, I think it really depends, but I think one thing we definitely do see with serial acquirers is, if your founders who are still key employees of yours who you want to make happy, own a significant part of the pre-closing cap table, and therefore it's the person you're making claims against, that's often the number one reason why buyers don't make indemnity claims, because you're effectively taking money out of your employee's pocket at that point, or at least that's how they may perceive it. So it's hard to answer that without knowing kind of the interpersonal social dynamics, of course. But I think many buyers do tread carefully in making those claims. I think part of the negotiation around the indemnity in some respects is, are you including, for example, option RSU holders in the indemnity? And part of the reason investors may want you to do that is simply so you're afraid of pulling the trigger in these sorts of scenarios, because you're taking more cash out of your own employees' pockets. But yeah, I don't have a perfect answer to it, but I think it's definitely a reason people can be hesitant to make claims unless they're very significant claims.
Well, I think it was a great answer to a general question, a very detailed question. John, anything to add there?
No, other than I'd leave it there. I think there's some insurance products that for future transactions that can certainly help mitigate the challenges with going after your now employees and partners that can help that.
Amazing.
That's a good point too.
Today.
Yeah. And our anonymous attendee says that was wise and appreciated. Thank you. Alrighty, let's see another question here. I believe this is from the founder's perspective, but how far back do the records need to be for the due diligence process? Is there a suggested checklist you can recommend?
So I think it depends. It's going to very much depend upon what I'll call the functional areas. What you'll typically see in a finance buyer, they're typically looking sort of 2 to 3 years. Tax is typically around the statute of limitations for whatever the tax items are. So I would say typically those from a finance and a tax. And IT tends to be much more real time, what sort of happened in the last, what's the current state? And then as you think about sort of cyber risk and whatnot, that's typically a couple of years. Brendan, from a legal perspective, I'm sure that it's very different depending on structure, but.
Yeah, I think that's a great answer, John. I think it greatly depends on the subject matter area, as you said. I mean, I'd say for some things like IP ownership, you were talking about like what's in the code base, like that's from the beginning of the company when the first line of code was written. For things like for other areas, it can be significantly less.
Great. All right, moving right along. Question here. We talked a little bit about like early stage first deals. So what are the biggest dangers of making your first acquisition too large relative to your size?
Yeah, I'll go ahead and go first on that one. I don't know that it's that big of a risk. I think it's a risk that you have to assume from a culture perspective. You see a lot of transformational transactions. And when I say transformational, I mean you're buying a really big company. It's entirely changing the business because it's the right move. It helps leapfrog you in the market that you're in. And sometimes if you're, early stage, mid stage, and you're buying an equal sized business, that can be a great enabler, a great transformer to growth. It can also be very challenging from culture and everything else. But again, you've got to think about the pros and cons there.
Yeah, I think that's right. I think it's also just like when you say too big, I guess like too big compared to other transactions you've done, or like too big compared to your company yourself. And what I mean by that is, it might be a very different transaction if you are acquiring something versus you're doing something akin to like a mergers of equals, because then if you're doing something that looks more like that, then all of those cultural issues can really come to the forefront. Who's actually going to be the CEO, who's actually running things. So I think I maybe wouldn't look at it through the lens so much of, is this acquisition like too big? But if you're pivoting from an acquisition to more of like a marriage of two companies and a mergers of equals type thing, that's just a bit of a different lens through which you have to evaluate it. Not that that means it's too big, but it's just a different deal.
Mm-hmm. And we got another question here around what you both were talking a little bit about, the buyers buying these companies for their talent, and not necessarily their valuation, their ARR, their financials. So how do you assign a value to the team competency, the cultural fit, during the negotiation process?
Yeah, I think when there's, I would say in a lot of technology companies, you have a lot of different metrics used for valuation. Other industries might be more of an EBITDA sort of multiple. In technology, is a lot of revenue or ARR or some other sort of metric. But when there's really no commercial business that exists today, I think Brendan said it earlier, it's, well, what is the buyer willing to pay type of deal? And I think that becomes sort of hard to suss out in terms of what that might be unless you have really good comparable transactions, which honestly, there probably are none that are really comparable to your circumstances if it really is a small team in technology. Part of what you have to think about is who is your buyer universe and what does your technology mean to them? Because that's going to be the lens they look through. They're going to think about it from a make to buy decision and how does your technology enable them speed to market, other elements like that. And you can sort of get some sense for what they might be willing to pay just based on how valuable it is to them. But it's much more art than any science.
Yeah, so we're not pulling out a net present value equation from finance. Nope.
Nope.
I mean, maybe the best way to find out is, try to get some competitive tension in the process. If someone comes to you and says, "Hey, I want to acquire your talent. Here's what I'm willing to pay for each employee," go around and see what the next guy's willing to pay. It's probably hard to judge without doing a bit of a market check.
Yeah. Oh, we have so many awesome team-related questions, which is great because you're both saying that that's pretty important. What's a best practice to structure a deal that will motivate current team and position them for market expansion?
Yeah, I think the incentives that you're putting with that team, every sort of agreement that I'll typically see in deal, you're paying the sellers a price for their equity in the business, but then going along with that is typically a management incentive plan or some sort of incentive plan for key employees. And it's about, well, what is the equity that you're going to give them for the go forward? What's the, we talk about it in retention or incentives, but they kind of mean the same thing at the end of the day. It's how do we keep the talent and how do we incentivize them? And that's typically goes together in the same agreement because the buyer's got the same questions and the seller wants to make sure they're taken care of and have a path forward. And you kind of come to alignment very quickly there for at least the very key people.
Brendan, you're nodding, but anything to add there?
Yeah.
John
No,
nailed it.
I think that's well said. No, he did nail it. I think it's like buyers and sellers come at it from different perspectives, of course. A buyer is going to be looking at it, okay, what cash or what kind of equity am I spending to acquire this business? And that includes what I need to motivate people on a go forward basis. So it's $100 million acquisition, but that's $80 million to the investors and $20 million, to the talent on a go forward basis. Of course, the investors just view that as a $80 million deal. So there's a little bit of different lenses that they think it through, of course. But I think, making sure that talent, which is driving the success of the company, continues to be there, continues to be happy, continue to be motivated, is a day one consideration.
Awesome. And back to the buy side question here. For a growth stage company that isn't a large corporate, what are some practical options for financing the acquisition? And they wrote some debt, seller notes, equity, insurance, issuance, earnouts, etc.
I think all of those are good tools. it depends on what you're going to be able to get your sellers to agree to, of course. I mean, I'd say an earnout from a buyer's perspective, you can think of it as, even if the earnout's achieved, right? Just imagine you set an earnout at a metric that's so low, it would be kind of insane for not to be achieved. That's effectively deferred purchase price. So I suppose, although John and I were, I think, sharing our sentiments that earnouts can be painful and maybe you want to use them with caution, I mean, that can certainly be one tool. Proposing the price being part stock, part cash can certainly help if you think that your stock's going to be attractive to the sellers. Rolling over some of the founders' equity, so it effectively becomes somewhat seller finance, and they become a part owner in the company could help. There's many tools. I'm sure John can think of more than I've been able to rattle off the top of my head.
I think those are all great tools. I do a lot of work with growth equity investors that are kind of funding the mid to late stage businesses. And there are a lot of the funding rounds that we look at for those investors where the use of the proceeds is to go make an acquisition. So Brendan listed out a great number of ones that you can sort of do as a standalone business. But the other option is you go raise more capital. And I see that happen a lot where, hey, I'm this big of a company and I need $50 million to go make a transaction. I need to go raise $70 million of fresh capital. And they go and do that sort of a round or something like that.
Oh, yeah, that's good advice. Staying on the buy side, when retaining the acquired CEO is critical, what are some best practices for defining their new role, granting them operational autonomy? I've seen this firsthand from the founder side, and structuring their incentives beyond the earnout with larger acquiring organization to keep them motivated or on the team for the long term.
I think a lot of it comes down to what are the size of the two companies. It's really hard to take two small to medium-sized CEOs and try to give them the autonomy that they probably want. There's probably just not enough scope in the business. I think that becomes very hard. But if it's a very large acquirer buying a business and it wants to give them the autonomy, BU sort of CEO, president of a division or whatnot, there's a lot of creative ways that you can do that in a larger organization. Yes, there's a lot of strings and rules in a larger organization just from a control perspective, but I think it becomes easier to give scope to that sort of senior level person when it's a larger acquirer. I think in the smaller ones, it becomes just culturally more challenging.
Yeah, I think that's right. I think that's well said. I think it's maybe also a cultural issue. It's going to depend on each company. And I think also thinking about, the people that you might want to keep around and keep happy kind of below that CEO level. Like what are they expecting? Are they expecting to report to that CEO because they really, really love her and can't imagine reporting to anyone else? And if so, that might be a strong consideration kind of where you slot that person into your organization.
Yeah, great advice. Because I've seen it firsthand. Let's see, what's the single most common reason acquisitions fail to meet their growth objectives? Specifically, how should a buyer structure the initial 30, 60, 90-day plan? We talked a little bit about this earlier, to secure the target's best talent, critical customer relationships, and value.
I think fail can mean a lot of different things. And so it's probably not a direct answer, but I see transactions fail because the model was too rosy. People needed too aggressive of a model to get the transaction approved, knowing that it was never going to sort of achieve that, or the likelihood of achievement of that was very low. So yes, easy to fail that way if you kind of went into it. And sometimes that's the right answer to get the deal done. Where I think the rest of it fails is in that planning. Is you just don't do enough integration planning. You don't have the roadmap for how these businesses come together to fit that strategic whole. And then talent or product or time passes, and that's the decay that you don't want.
Brendan, anything?
Yeah, I have very little to add there because I think that was very well said. I mean, I think just going into the transaction with maybe too much optimism, perhaps, and not understanding how difficult integration can sometimes be, can be a challenge. And as we discussed before, just having a very detailed and well thought out integration plan. If for example, if the part of the impetus for the deal is to be able to cross-sell customers. Like, how easy will it really be to do that? And just kind of thinking all of those things through kind of before you actually get to the signing.
Awesome. And I giggle, somebody's otter just wrapped up your key takeaways, Brendan. But we are almost at that time, at the top of at the end of our boot camp here. But gentlemen, given everything that we've talked about on both sides of the M&A landscape equation that I've been quizzing you on, what's one key takeaway that if somebody was going to look to the last couple minutes of this boot camp that you'd give our buy side, sell side, both sides for today?
I would say if you're a buyer, look strategically for value-driven deals. I'd say if you're a founder, get your house in order and get ready.
Awesome, John.
I'm going to sound like a broken record, but either side, it's the why. It's why are we doing this transaction, and is it the right transaction? Like, I've been doing M&A for 20 years. I think it's really interesting and exciting. People seem to like the idea of it. It seems somewhat sexy, but actually doing it is really hard. It's really disruptive to the buyers and the sellers, to the actual businesses. And it's not like buying a house. It's not like getting a new vendor. You have to really be committed, and it has to be a really high hurdle of why you're doing this to make it work.
Great. What a golden nuggets to end this conversation. Brendan, John, thank you so much. It's been fun. I've learned so much, and I hope everybody on this call has as well during this conversation.
Thanks, Colin.
Yeah, thanks, Colin.
Appreciate both of your time. And for everyone on this call, thank you for joining. Hopefully you've enjoyed all these insights provided by our experts during this fall M&A Bootcamp. We'd love for you to join some of our upcoming webinars so you can view them in the chat that's just about to drop. And thank you all for joining us today. Again, Brendan, John, thanks for joining. And we look forward to welcoming you all back online soon. Thanks again.
Absolutely.
Bye-bye.